We're watching something extraordinary unfold in real time, and most analysts are treating it like a routine policy adjustment. Over a dozen Chinese provinces have just slashed their GDP growth targets for the first time in 4 years. This isn't a recalibration. This is a structural admission that the growth model that powered the world's second-largest economy for 3 decades is breaking down. And what comes next will ripple through global markets, supply chains, and monetary systems in ways that most investors, policymakers, and everyday citizens are not prepared for. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. What we're examining here is the anatomy of a systemic shift, the kind that doesn't announce itself with a singular crash, but unfolds through a cascade of seemingly disconnected policy decisions, each one signaling that the underlying engine is seizing up. Let's be clear about scale. China represents roughly 18% of global GDP. It's the largest trading partner for over 120 countries. It consumes half the world's cement, half its steel, and holds over $3 trillion in foreign exchange reserves. When growth targets get slashed across provinces that collectively represent hundreds of millions of people and trillions in economic output, this is not a local story. This is a global rebalancing event. And the reason it matters so profoundly is because China's growth model was never designed to slow down gracefully. It was built for perpetual expansion, and when perpetual expansion becomes mathematically impossible, the system doesn't ease into a soft landing. It fractures. The provinces cutting targets include some of China's most economically significant regions. We're talking about manufacturing hubs, export powerhouses, real estate-dependent economies. Reported data from provincial congresses in January and February of 2026 show targets dropping from 6% down to 4.5%, from 5.5% down to 4%. These aren't marginal tweaks. In a command economy where hitting targets is politically essential, lowering them publicly is an acknowledgement that the old playbook no longer functions. It's the equivalent of a corporate board slashing revenue guidance not because of a bad quarter, but because the entire business model is obsolete. To understand why this is structurally significant and not just cyclical weakness, you have to go back to how China achieved its growth miracle in the first place. For 3 decades, the formula was simple and brutal. Mobilize cheap labor, subsidize exports, suppress domestic consumption, pour concrete, build infrastructure, finance it with debt, and repeat. Local governments competed to hit GDP targets by borrowing massively, often through off-balance sheet vehicles. Developers built cities before people arrived. Banks lent because the state guaranteed it. Growth was the mandate, and every incentive in the system rewarded expansion regardless of profitability or sustainability. This model worked extraordinarily well when you had surplus rural labor to urbanize, when global demand for manufactured goods was insatiable, when infrastructure was genuinely needed, and when debt was relatively low. But by the mid-2010s, every one of those conditions had reversed. The labor force peaked, global demand shifted, infrastructure became redundant, and debt exploded. By 2023, total debt in China, including household, corporate, and government, was estimated at over 300% of GDP. That's not unusual for a developed economy, but it is unprecedented for a middle-income country still trying to grow at 5 or 6% a year. What happens when debt-fueled growth hits physical limits is well documented historically. Japan in the late 1980s built everything twice. They financed it with cheap credit and asset bubbles in real estate and equities. When the bubble popped, the economy didn't collapse overnight. It entered a grinding deleveraging cycle that lasted decades. Growth targets became aspirational fiction, stimulus became structural, and an entire generation watched wealth stagnate despite continued employment. The Soviet Union in the 1980s faced a similar structural exhaustion. Central planning had delivered industrial growth for decades, but by the time systemic inefficiencies compounded, no amount of political will could reverse the decline. Targets were cut quietly, then openly, then abandoned. The system didn't explode, it eroded. China today is not a direct analog to either, but the mechanics are strikingly similar. You have an economy that grew by mobilizing inputs, labor, capital, land, and when those inputs max out, productivity gains have to take over. But productivity growth in China has been declining for years. Industry data suggests that total factor productivity, the measure of efficiency gains, has been near flat or negative in key sectors since the late 2010s. That means more debt is required to generate each unit of GDP. And when more debt generates less growth, you're not in a cycle. You're in a trap. The real estate sector is the clearest signal. Property development has accounted for as much as 25 to 30% of GDP when you include upstream and downstream industries. Evergrande, Country Garden, and dozens of other developers defaulted or restructured over the past 3 years. New home sales collapsed. Prices in Tier 2 and Tier 3 cities fell double digits. Local governments, which funded themselves by selling land to developers, saw revenues crater. And because infrastructure spending was often financed against land sale revenues, the entire fiscal model broke. Provincial governments are now caught in a vice. They can't hit old growth targets without borrowing more, but borrowing more to fund unproductive projects just deepens the hole. So they do the only rational thing. They lower the targets. But lowering the targets doesn't fix the debt. It just formalizes the slowdown. Most observers miss the significance because they're watching for a Lehman moment, a singular event that triggers panic. But systemic crises in command economies don't work that way. There's no market mechanism to force sudden repricing. Instead, you get managed decline. Targets get cut. Stimulus gets announced. Defaults get restructured quietly. Growth slows, but employment is maintained through state-owned enterprises that operate at a loss. The financial pain is distributed and delayed, but it doesn't disappear. It accumulates. What makes this cycle different from past slowdowns is the global context. In 2008, China could deploy a massive stimulus and pull the world economy forward. Infrastructure spending exploded. Commodity prices surged. Global manufacturers cheered. But that stimulus created the debt overhang we're dealing with now. And this time, there's no dry powder left. The central government has fiscal space, but deploying it at scale would require monetizing debt or accepting much higher deficits, both of which carry political and economic risks that Beijing has been unwilling to embrace. Meanwhile, the external environment has shifted. The United States and Europe are reshoring supply chains. Tariffs and export controls are fragmenting trade. Demand for Chinese goods is softening structurally, not just cyclically. The Belt and Road investments of the 2010s are producing returns far below expectations, with several recipient countries restructuring or defaulting on Chinese loans. The geopolitical and economic tailwinds that powered the previous 3 decades have turned into headwinds. Demographics compound the problem. China's working-age population peaked in 2015 and is now declining. The one-child policy created a demographic structure where the ratio of workers to retirees is collapsing faster than in almost any other major economy. By 2030, estimates suggest there will be fewer than 2 workers for every retiree. That means consumption won't surge to replace investment-led growth because households are saving for aging parents and uncertain healthcare costs, not spending on consumption. Youth unemployment, particularly among college graduates, has been running at levels officially reported above 20%, though independent estimates suggest it could be higher. The government stopped publishing the data for several months in 2023 before revising the methodology. When a government stops reporting inconvenient statistics, it's not because the numbers improved, it's because they became politically unsustainable to acknowledge. So, what does cutting provincial GDP targets actually signal? It signals that the people running the system understand the constraints better than the market does. They know the debt can't grow faster than the economy indefinitely. They know real estate isn't coming back. They know fiscal revenues are structurally impaired. and they know that the political cost of admitting slower growth is now lower than the economic cost of pretending it's still achievable. This is the part where most people push back. They say China has weathered slowdowns before. They say the government has tools. They say consumption will pick up. They say technology and green energy will drive the next phase. All of that contains elements of truth, but none of it changes the fundamental arithmetic. You can't grow out of a debt trap when the debt is growing faster than the economy and the population is shrinking. You can stimulate consumption, but consumption in China is barely 60% of GDP, far below the global average, and raising it requires shifting income from state-owned enterprises and local governments to households, which those entities are institutionally resistant to doing. Technology offers hope, but technology-driven growth requires innovation, risk-taking, and open information flow, all of which are being constrained by tighter political control. The regulatory crackdowns on tech companies in 2021 and 2022, the emphasis on common prosperity, and the focus on national security over efficiency all point in the same direction, toward a system prioritizing control over dynamism. You can have control, or you can have innovation-led growth, but historically, you rarely get both. Green energy is a real opportunity, and China dominates global supply chains for solar, batteries, and electric vehicles. But that dominance was built on subsidies, cheap capital, and export markets. If those export markets erect barriers, which they increasingly are, then overcapacity becomes a domestic problem. And overcapacity in an economy already drowning in unused infrastructure is deflationary, not growth-enhancing. The most dangerous assumption people make is that because China avoided a hard landing in the past, it will continue to do so indefinitely. But every time you avoid a hard landing by adding more debt, you make the eventual adjustment harder. Japan avoided a crash in 1990. It also never recovered the growth it lost. The deleveraging process took 30 years and is arguably still ongoing. China's debt is larger, accumulated faster, and the demographic and geopolitical context is less favorable. History shows us that economic systems built on perpetual input mobilization eventually hit physical limits. The Soviet Union hit those limits and collapsed. Japan hit them and stagnated. The United States hit them in the 1970s and had to completely restructure its economy through inflation, default by devaluation, and a painful transition to services. China is hitting those limits now, and the cutting of provincial growth targets is one of the clearest signals that the people inside the system know it. What happens next is not a sudden collapse. It's a grinding rebalancing. Growth slows structurally. Debt gets restructured, often quietly through state-directed mergers and bailouts that don't show up as defaults. Unemployment rises but is masked by state employment. Consumption stays weak because confidence stays low. Deflation becomes a persistent risk as overcapacity meets weak demand. And the political system tightens control to manage social stability as economic opportunities contract. For the rest of the world, this matters immensely. If China grows at 3 or 4% instead of 6%, that's trillions in lost demand. Commodity exporters from Australia to Brazil to Africa feel it. Manufacturers in Southeast Asia that depend on Chinese supply chains feel it. European luxury brands that rely on Chinese consumers feel it. And global financial markets that priced in Chinese growth as a constant feel it. The dollar strengthens because capital flows out of emerging markets and into safe havens. Treasury yields compress. Commodity prices soften. Multinational corporations that built entire strategies around Chinese growth have to restructure. And policymakers in the West face a world where the engine that pulled global growth for 2 decades is no longer firing. This is not a prediction. This is a description of forces already in motion. The provincial GDP cuts are not the beginning of the story. They're the formalization of a shift that's been building since the debt binge of 2008 to 2015. The real estate collapse, the demographic decline, the geopolitical fragmentation, the regulatory crackdowns, they're all symptoms of the same underlying condition. An economic model that worked brilliantly for 3 decades and is now exhausted, Understanding this doesn't require believing in any particular timeline. It requires accepting that systems built on unsustainable premises eventually have to adjust, and that adjustment is rarely smooth. China spent 30 years proving that command economies could deliver growth if they borrowed enough and built enough. Now it's entering the phase where that debt has to be serviced, those buildings have to find occupants, and that growth has to come from productivity, not just input mobilization. And at this stage of the cycle, with these structural constraints, slower growth isn't a policy failure. It's a mathematical inevitability. The provinces are simply acknowledging what the system has already decided.